Fed rate cut bets ease back after stronger US jobs and services reports. New Zealand's jobless rate rises, but maybe through the worst. Indonesia's growth is dented, and deflation continues in Thailand. That's coming up in our 5 Things in 5 Minutes on Wednesday, November the 5th. And then in our deep dive interview, ANZ senior economist Miles Workman explains why the Reserve Bank of New Zealand will be feeling comfortable with how the country's labour market is performing.
Given that these data landed almost exactly as the Reserve Bank had been forecasting, you'd have to conclude that the most likely outcome here is a 25 basis point cut in November.
But first, in 5 and 5 with ANZ, market expectations for a Fed rate cut in December eased back slightly overnight after slightly stronger US jobs and services data. October saw the first positive ADP jobs report in 3 months, up 42,000. Although, as ANZ head of G3 Economics Brian Martin says, momentum is still soft.
The 3-month moving average of ADP employment gains is just over 3,000 at 3,300 per month. If we take that as a proxy for non-farm payrolls and hold the participation rate in the economy steady where it was at August, we estimate that equates to an unemployment rate of 4.5% at the end of this year. That's up from the latest reading of 4.3%. So the labour market is still soft. The message is that that level of hiring is going to be consistent with upward creep in unemployment over time. We therefore think it is consistent with the Fed easing policy further at coming meetings.
As at 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.65% and the Nasdaq was up 0.9%. The yield on the US 10-year Treasury was up 7 basis points at 4.159%. West Texas oil futures fell 1.1% to $59.90 US a barrel. Gold was up 0.9% to $3,996 US an ounce. The US dollar index was flat. The Aussie dollar was up 0.3% at 65.13 US cents, and the Kiwi was up 0.1% to 56.62 US cents. Number 2. The ISM Services Index in the US rose to its highest level since February, driven by a rebound in new orders. Brian says an important subcomponent, tracking services prices paid, remains sticky.
Inflation isn't necessarily accelerating, but it is staying sticky at elevated levels. And as we know, that makes some of the FOMC uncomfortable. So this debate between needing to address labour market weakness and whether or not that's heralding a more pronounced downturn in the economy versus the need to get inflation down is going to continue. We know the FOMC is split, and we'll just have to wait and see how any data comes out in coming weeks.
Number 3. New Zealand's unemployment rate rose 0.1 percentage points to 5.3%, as expected in the September quarter. That was the highest since late 2016. Here's ANZ senior economist Miles Workman with the key details.
Employment was flat quarter on quarter, so there was no growth there on that metric. Meanwhile, we had 0.3% growth in the working age population, which was partly offset by a fall in the participation rate. That fell 0.2 percentage points to 70.3. So essentially what that meant is labour supply grew 0.1% and labour demand was unchanged, and that's what drove the unemployment rate higher.
Number 4. Indonesia's GDP growth fell back slightly to 5.04% year-on-year in the third quarter. That was near expectations. ANZ economist Crystal Tan says social unrest in late August led to falls in private consumption and investment, but there were bright spots.
The strongest support came from net exports. Export growth was robust and came in at 9.9% year-on-year, and it's plausible that front-loading ahead of US tariffs contributed to this strength. But what's also notable is that this strength in net exports was accompanied by a sharp drawdown in inventory, so possibly suggesting some caution about future demand as firms opted to run down stock in order to meet orders.
Number 5. Thailand's consumer price index fell 0.76% in October from a year ago, the 7th straight month of deflation. Crystal says the drop was led by sharp energy price declines following government cuts to diesel and gasoline prices.
Now, if we look at granular data, that's also showing a rising share of product groups with weaker inflation momentum. So this is a signal of persistent weak price pressures. Now, couple that with slowing activity and also still negative loan growth. We do think there's a good case for a 25 basis point policy rate cut at the Bank of Thailand's next meeting in December.
Crystal Tan there. Now, in our deep dive interview, ANZ senior economist Miles Workman says the detail in New Zealand's September quarter jobs and wages data means the Reserve Bank of New Zealand may be feeling quite comfortable with current rate cut plans.
Some of the details under the hood did suggest that there is tentative evidence here that the labour market is about as bad as it's going to get. So paid hours, that rose 1.3% quarter on quarter. That's following 5 consecutive quarters of contraction. Meanwhile, hours worked rose 0.9% quarter on quarter, following 6 consecutive quarters of contraction. So what's really going on here is we know that labour demand's been quite weak, and in fact aggregate demand's been quite weak. So firms have been facing quite soft demand for their goods and services, and in response to that they've been reducing the available hours for their workers. So the fact that we did see paid hours and hours work both increase in Q3 does suggest that that demand's starting to come back online. So this is one of the first parts of the labour market where you might actually expect to see evidence of a tentative turning point. So what that does suggest to us is it does give us confidence that these Q3 labour market data are hopefully going to be the worst of it this cycle.
So is there anything in the wages data out today that adds to that picture?
Yeah, so the wages data does appear to be following the broad trend that you would expect it to when there is excess capacity in the labour market. So basically what we've seen is the demand for labour has contracted by more than labour supply. That's created a degree of spare capacity in the labour market, which has essentially meant that workers have had less bargaining power when it comes to wage negotiations. So that's seen wage growth slow. The most stable measure that we take a reading from is the labour cost index. For the private sector, we saw wages there grow 0.4% quarter on quarter, which saw annual growth in that measure slow 0.2 percentage points to 2.1% year on year. So as far as the Reserve Bank is concerned, this is the type of slowdown that they've actually been trying to engineer this whole time. This is monetary policy doing its thing and inducing a degree of spare capacity in the economy. Unfortunately, workers do feel the brunt of that, but what it also means is that the labour market is now not looking like it's going to be a source of re-accelerating inflation pressures anytime soon. So that paves the way for the Reserve Bank to continue easing monetary conditions. And I think given that these data landed almost exactly as the Reserve Bank had been forecasting, you'd have to conclude that this is that the most likely outcome here is a 25 basis point cut in November, and in our view that's the end of the easing cycle. However, we wouldn't be surprised to see the Reserve Bank actually deliver that 25 basis point cut and then signal a willingness to ease further dependent on how the data unfold.
So when might we see that peak in the unemployment rate, and how quickly could it come off?
So from here, our expectation would be that both labour demand and labour supply will recover. Now, we're already seeing evidence of recovering labour demand in job ads. They've actually started turning a corner. I wouldn't say that the level of job ads is strong right now, but they have lifted off their recent floor. So that does suggest that businesses are starting to think about taking on a bit more headcount based on an expectation that there is an economic recovery on the way. But what always happens with the labour market is when you do get more demand for labour, you also tend to get more supply. So first of all, you get more people deciding to participate in the labour market because if they think economic conditions are a bit better and they have a higher chance of getting a job, they're more likely to go out and start looking for work. But also net migration. So when the labour demand is higher, you do get more people thinking about coming to New Zealand. So what we do expect to see with the recovery from here is both the supply of labour and demand for labour increasing in tandem. But the net expectation would be that the demand slightly outpaces the supply story, and that would see the unemployment rate continue to trend lower from the end of this year.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 6th. Catch you tomorrow with a rate decision from the Bank of England, expected by ANZ Research to be a hold due to high inflation. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.